Howdy, Jacob here. Today we're looking at Rollins, company 107 of our high ROIC screener. 22.6 billion market cap, slightly higher enterprise value in the commercial services and supplies industry. Return on invested capital, very consistent, above 20%, very impressive. Growth in the upper single digits year over year for the most part. In the last 3 years, low double digits, so impressive there. Operating margin and gross margin both increasing. A lot of good signs here. Let's look at the balance sheet. Shows 104 million cash on hand with 491 million in short-term and long-term debt. Nothing concerning there. Yeah, so that's about a little over a year of their free cash flow to pay off that long-term debt. Definitely no concern there. The growth of their cash from operations is crazy. Very good, very consistent. Capital expenditures are nearly identical. That's interesting. Acquisitions is a big use of their cash flow. We see about a 25 to 30% of their free cash flow is used towards making acquisitions. And then right now, that dividend is paying out 60%, with maybe 15 to 20% going towards share repurchases. So they're a big acquisition company. Let's see, what is that? Provide pest and wildlife control services to residential. Okay. So let's incorporated in 1948. They've been around a while and their growth is still like this. That's very impressive. So let's get to making some assumptions. I think that I don't know if growth is going to be extremely sexy for them. Let's see, 6%. They have been extremely consistent though, so I'll put a bit of premium even at the end of 7 years above the market, saying that they might have a moat in the fact that margins are increasing, revenues increasing, great return on invested capital, and it's not necessarily due to buying back shares. They are buying back shares, but not so much in excess that it makes the ROIC number negligible. And so, um, yeah, very, very impressive numbers here. Margin side, I like that free cash flow is higher and it is darn consistent. Let's do 14, 16. Let's say they buy back 0.5% of shares. Buying back 0.5% of shares for them would be about, let's see, 220, 400 million. 200 million is 0.5%. Yeah, I mean, I think that's reasonable. The dividend has grown quite a bit, and the dividend payout was about 60%. So I'll just have that grow actually with revenue to have this company have other use of their cash to do the acquisitions they want, and then hopefully buy back shares that are super cheap. But right now, it doesn't look very cheap. Based on my valuation, I'm saying it needs to fall 73%. I might be being conservative on the revenue side since 6% is definitely on the lower end from the last 10 years. But I just wonder if this able to double digit a year is able to go forward, given that just looks like they do pest control for residential properties. And I mean, I could be way wrong. Maybe this is a business that's thriving. It's just not one that I would think to really grow at those types of rates. So this is just me putting in my understanding of the business as well as looking at the numbers. And again, right now it just looks a little expensive. But hopefully you enjoyed the video and have a fantastic rest of your day. Thank you.